Were you taken off guard by the fast changes in the housing market this year? If so, don't you wish you could have been able to predict it a little bit better? I'm Kathy Fetke, and welcome to On the Market's YouTube channel presented by Fundrise. So I'm going to compare what happened this year to surfing. And when you go out to surf or do any water sport for that matter, you always check the tides first. Right now, the tide is coming in. It's looking pretty good out there actually. And the tide is coming in and it's going to be high tide soon. And a little bit earlier, and this morning for sure, it was very low tide and all of the rocks over there were exposed. So what does this have to do with the housing market? Well, you can predict the tides. It's pretty easy. You look it up and you see if it's going to be low or high tide, and it's going to matter a lot if you're going to go surfing. Because if it's low tide like it was this morning, you could end up hitting rocks because they're really exposed. And if you go out now at high tide, well, this whole beach might be gone and you would have no way to get back to the beach because you just run into a house. So with housing, we have had warning as well. And it's the Federal Reserve. Investors on Wall Street listen to everything that comes out of Jerome Powell's mouth, the chairman of the Fed. And that's because they're going to tell you what the tides are in the economy, whether money's coming in or going out. And the Fed controls that. So the Fed controls that by either raising rates, the overnight lending rates, or lowering them. And when the Fed raises rates, they're actually trying to make money more expensive, and therefore people borrow it less and spend less, and it slows down the economy. And then if the economy slows too much, then they lower rates and everybody wants to borrow money, and that gets things going and people are working again and it speeds things up. So sometimes they don't get it right. Obviously after COVID, the Fed really needed to come in and help out because millions of people weren't working and had to stay at home. So the way they dealt with that is printed a whole bunch of money and stimulated the economy, dropped overnight lending rates to zero, and increased the amount of money circulating. So imagine all this water coming in, increased the amount of money circulating by like 40%. Some say even 50%. More money in the system in just a matter of a year or two. That's flooding the market with money. And they overcorrected because in addition to that, the Fed also stimulated the housing market by buying mortgage-backed securities to keep interest rates low. And they did this until March of this year when housing had already gone off like a rocket ship. It didn't need stimulation. It was stimulated. Prices went up 20% on average, 40 to 50% in some markets. I mean, you know, it's been insane. So in order to undo what they did, they had to reverse quickly and take all that money out of the system. And of course, that's why rates went up. But the Fed warned us back in February. They said, we're going to raise rates like 7 times. And that's what stock market investors paid attention to. They're like, oh boy, we better prepare for this. It's going to dramatically slow down the economy, which is what the Fed wants. Because when the economy's overstimulated, then you have too many jobs for workers, right? That's what we've got right now. So employers have to pay higher wages, and then that of course is passed on to the consumer and higher prices. So the Fed desperately wants to bring inflation back down to 2% and warned the markets that they were going to slow things down. So really it should have been no surprise at all that there's higher rates and mortgages and that the time to sell was before that happened, right? And to prepare for more inventory on the market. Now keep in mind that the Fed's going to have to, there's a lot of work to do to get more inventory on the market still because there's so much demand right now for inventory, for housing, and builders just can't build it fast enough to keep up with the massive generation of millennials. So the Fed's efforts to raise rates to slow it down may not work. They overstimulated, they shouldn't have, now they're trying to pull it back out. It may not work. But here we are. So in the future, if you don't want to be taken off guard by changing markets, then just listen to what the Fed is going to do. and pay attention. Here we are at a time when they've raised rates so quickly from 0 to 2.5% and plan to do a few more in the coming months that will probably bring us up to 3 or 3.5% for the overnight lending rate, which would generally mean rates would be a couple points higher than that. But if you watch my other video, you'll see I don't think rates are going to go very high. I think they're going to come back down because the economy is slowing and the Fed's going to just keep it there and eventually lower it again if we do hit a recession, which it seems like would be a minor one given how many jobs are out there today and that consumers are still spending and that homeowners have a record amount of home equity in their houses and record low interest rates and low payments. So homeowners are looking good. No housing crash there. The main issue today is high home prices mixed with these high mortgage rates is making it very, very expensive for people to get into the housing market, which means that most likely they'll be forced to rent for a while until rates come back down. I'm Kathy Fedke, and again, this is On the Market's YouTube channel presented by Fundrise. And if you have any thoughts on what I've just said or comments or input, put it in the comments because I'll be sure to respond. So be sure to subscribe and hit the like button if you liked it, because that will give you access to more videos. See ya!